Okay, let's get right into it. For what feels like forever, the only word on anyone's mind has been inflation. But what if I told you that one single number just flashed across the screen that could change the entire game for investors? We're talking about the new US inflation expectation. And in this explainer, we're going to break down exactly what that means, why it's such a big deal, and how it might just be signaling a huge new window of opportunity. And here it is, 3.2%. Now, I know it might not look like much, but trust me, this little number is sending massive ripples through the financial world. You can already see it. Markets are reacting, stocks are starting to climb, and you can bet the smartest investors are leaning in and paying very, very close attention. This number, this is the hero of our story today. So, naturally, that leads us to the million-dollar question, right? Is this it? Is this 3.2% the all-clear signal that the economic storm clouds are finally starting to part? Well, to answer that, we need to look past the number itself and really dig into what it's telling us. To really grasp the opportunity here, we've got to understand this signal itself. You see, this isn't just another economic stat to get lost in the noise. Nope, this is a measure of something much, much more powerful. It's a measure of confidence. And this is an absolutely critical distinction. We are not talking about the inflation number you see on the news tonight. That's the past. This is about expectations. It's what businesses, consumers, and investors believe is going to happen tomorrow. It's a forward-looking indicator, and it basically gives us a sneak peek into where the smart money thinks the economy is headed. So when that number drops to 3.2%, it means the collective mindset is shifting. It's like the entire market is taking a deep breath and starting to believe, hey, maybe the worst is over. Maybe inflation is finally being tamed. And in the world of finance, well, confidence is everything. When confidence comes back, money that's been sitting on the sidelines in fear starts to get back in the game. Now, this return of confidence doesn't just happen in a bubble. Oh no. It sets off this incredible chain reaction across the whole economy. The best way to think about it is like a line of dominoes, you know? One little tap, and the next one falls, and the next, and the next. So here's how those dominoes fall. It all starts with those lower inflation expectations. Investors start to think they won't need crazy high returns to beat inflation, so bond yields start to drop. Well, when bond yields fall, it suddenly becomes cheaper for companies to borrow money, to build, to innovate, to expand. And when borrowing is cheap and investment is flowing, guess what tends to happen? Stock valuations rise. That right there, that's the engine that could power the next big market run. And this is a lesson that every single investor needs to burn into their brain. The market is a forward-looking machine. It doesn't sit around and wait for the news headlines to say, hey, everything's perfect. It tries to price in the recovery before it even happens. So while a lot of people are still stuck on today's gloomy news, the real opportunity is found by looking at where things are going, not where they've been. Okay, so we get the why. We understand the mechanics. Now let's get to the fun part, the where. Which specific areas of the market are really poised to benefit as this new chapter gets started? Let's break it down. First up, you've got growth stocks, especially in tech. These companies are all about future potential and often borrow money to fuel that growth. They got hammered when rates were high, so as borrowing gets cheaper, they could see a huge resurgence. Think about ETFs like QQQ. Next, long-term bonds. This is simple mechanics. Bond prices move in the opposite direction of yields, so as yields fall, the value of existing bonds goes up. And finally, real estate. Cheaper borrowing is the lifeblood of the property market. It could slowly breathe new life into everything from housing to commercial buildings, which you can often invest in through what are called REITs. But, and this is a big but, please remember, this is not about betting the farm on one horse. Even though some sectors look really promising, the golden rule of investing never, ever changes. Diversification is your best friend. Building a balanced portfolio across different assets is what protects you from the unexpected and allows for that nice, steady growth over time. You know, knowing where the opportunities might be is one thing, but actually having the right mindset to act on them, that's a whole different ballgame. And honestly, it's what separates the pros from the amateurs every single time. This chart right here really says it all. The amateur investor, they wait for certainty. They wait until the news is good and everyone feels comfortable. But by then, the biggest gains are usually gone. The professional, on the other hand, understands you have to get positioned during the uncertainty. They don't just dump all their cash in at once, they scale in piece by piece. And they never, ever think it's a no-risk situation. They know volatility is just the price you pay for growth. So let's be crystal clear on the big traps to avoid. Number 1, trying to time the market perfectly. I promise you'll always be too late. Number 2, getting swept up in the excitement and going all in one go. And number 3, probably the most dangerous, believing that just because inflation is falling, all the risk has magically disappeared. There's always risk. The name of the game is managing it. At the end of the day, it all comes down to a really simple shift in how you think. This isn't about having a crystal ball. It's not about predicting the future. The goal is just to read the signals the market is giving you, like this 3.2% number, and then position yourself intelligently for the most likely outcomes. That's it. All right, so let's zoom out for our final thought. What does all of this really mean for your long-term plan? It's a powerful reminder that markets move in cycles. Every single period of fear and uncertainty eventually, always, gives way to a new period of growth and opportunity. You've probably heard this saying 1,000 times, but it's a classic for a reason, and it has never been more true than in moments like this. The people who consistently build wealth are the ones who just stay in the game. They keep learning, they keep investing, and they stay consistent through the good times and the bad. It's a marathon, not a sprint. So as we wrap this up, I want you to look at that 3.2% figure and see it for what it is. It's not just a piece of data. It's a signal. It's a green light blinking, telling us that the landscape is changing, that new opportunities are taking shape, and that the next chapter for the market might already be starting to be written. While most of the world is focused on inflation slowing down, smart investors are focused on opportunities speeding up. You don't have to predict exactly what comes next, but you absolutely have to be ready for it. So the only question left to ask is, are you?